Hi there and welcome to our channel. My name is Sarah and I'm here today with iHealthBrokers to discuss how to calculate your modified adjusted gross income for marketplace insurance plans. So if you've explored Healthcare.gov, you've probably noticed that one of the first things they ask you is to estimate your income for the upcoming year. Specifically, they're going to ask you about your MAGI, which is your modified adjusted gross income, which is what we're going to be talking about in today's video. Now, estimating this income accurately is extremely important in determining your eligibility for those premium tax credits. Now, these premium tax credits basically lower your monthly premiums to a point where you can save thousands of dollars per year. So it's really, really important that you estimate accurately. Now, estimating inaccurately can be pretty detrimental. If you overestimate, you may make yourself ineligible for those premium tax credits, which could result in you leaving basically thousands of dollars on the table and overpaying for health insurance. And if you underestimate and you end up making more money than what you're estimating, basically you may have to pay all those premium tax credits back come tax time, which is not a pleasant or welcome surprise. So today we're going to walk you through calculating your MAGI. If you have any additional questions, please feel free to leave them in the comments below, or you can give us a call here at iHealthBrokers at 888-410-0344. As always, I make sure to point out that we are licensed health insurance brokers. We're licensed nationwide, and of course there is no charge for our services. Additionally, we release these videos on a weekly basis, so please make sure to check out our channel because there are tons of other informative videos all about marketplace insurance, saving money on insurance, and health insurance in general. The first thing you need to understand is the difference between AGI, which is your adjusted gross income, and MAGI, which is your modified adjusted gross income. Your AGI is really important for tax purposes. Basically, it's your gross income minus deductions. Your gross income includes your wages, dividends, capital gains, business income, retirement distributions, as well as other income. You're able to itemize these deductions or take the standard deduction. Once you've subtracted these deductions, you're left with your AGI. And this is where you have a little bit of wiggle room. So this is where you really want to focus. Now, you may want to work with an accountant at this point because they may be able to point you towards some additional deductions that you're unaware of, especially if you are enrolling in marketplace insurance and you're on the cusp of one of the income brackets that we're just about to talk about. Then your AGI is going to be very, very important because it has a direct impact on your MAGI, which is what Healthcare.gov is going to ask you about. So yes, working with an accountant may cost you $100, $200, more or less, dependent upon where you live and how complicated your taxes are, but it could end up saving you thousands of dollars. So it's just something to take into consideration. Okay, so here's what I mean about those income brackets. Okay, so we're going to Healthcare.gov, and then I want you to click over here where it says See Topics. And you're going to click on See If You'll Save. All right, so it's going to ask you a couple questions, and here's where we're going to look at those different brackets that I've mentioned. So how many people are in your household? Include yourself, your spouse if married, and anyone you'll claim as a tax dependent in 2021, even if they don't need coverage. So you're going to enter how many people are in your household. So let's put 2. Now select what state do you live in. We're just going to pick Alabama because it's the first option. And now it's going to show me income ranges. Okay, so these are the brackets that I'm talking about. So 1, 2, 3, 4. So the first income range is below $17,240. So when I click Submit, look what it says. You're probably not eligible for Medicaid based on your income alone. You may qualify for Medicaid based on your income, family status, disability, or other factors. So we've mentioned this in other videos. Medicaid eligibility is determined by your income, your household size, and your state. Different states do have different criteria. So basically it's saying that if you make below this amount, you're not definitely eligible for Medicaid, but you may be eligible for Medicaid, so it's something that you're going to want to look into. So basically, it's prompting you to look into Medicaid, because if you are eligible for Medicaid, you're going to have extremely low cost or no cost health insurance. So if this is your income, that would obviously be your best option. Now let's look at the next tax bracket, income bracket rather. Okay, so I'm going to click there. If your income is $17,240 to $43,100, and as a reminder, this is based on the information that we put in. When you put in your specific information, you may get different results. So if this is your income range, if this is the bracket you fall into, you may qualify for a marketplace plan with lower monthly premiums. So this is what we're talking about, those premium tax credits that we've mentioned a couple of times. So this is where when you move forward, you'll see that you'll be eligible for a tax credit of X amount, and it'll show you actually what it would have been without the premium tax credit, and now what you'll be paying on your monthly premium. It's going to be a couple $100 usually, or more. So it says you may qualify for a marketplace plan with lower monthly premiums plus extra savings, including lower deductibles and co-payments. To get the extra savings, you must enroll in a plan in the silver category. So basically, you're going to be eligible for a premium tax credit regardless of which category plan you choose, but there may be some extra savings if you enroll in a plan in the silver category. Now let's look at the third bracket. So this is if your income is $43,100 to $68,960, you may qualify for a marketplace plan with lower monthly premiums. So there's none of those extra savings of the lower bracket, but you're still going to get those premium tax credits, which is going to lower your monthly premiums significantly. And then finally, there's the last bracket, which is anything above $68,960. So it's going to say you won't qualify to save on an insurance plan. Not ideal. So it says you can buy one through the marketplace at full price, or you can get insurance other ways. So if this is where you fall and you're ineligible for a premium tax credit, no matter what you do, if you're following some of the other tips in this video and you're still ineligible for one of those tax credits to help you save money on your insurance premiums, then there are other options for you, and there are still actually some great money saving options for you. You just need to maybe be a little bit more creative. So as always, we recommend contacting a broker. Okay, we're going to leave it at Healthcare.gov there for the time being. If you want to do a deeper dive of Healthcare.gov, I suggest you check out one of our other videos, which I'm going to put in the description below. We have a couple of videos that are dedicated specifically to navigating Healthcare.gov, and there you'll see specifically exactly how much those monthly premiums can be lowered by becoming eligible for a premium tax credit. However, I can tell you this. Generally speaking, if you are eligible for a premium tax credit, you're going to save hundreds of dollars per month, maybe more dependent upon your household size. So eligibility for a premium tax credit is a major factor in the affordability of your health insurance through marketplace plans. So that's why we're sort of harping on this a little bit. And yes, I am spending a little bit more time on AGI right now versus MAGI, but we're going to get back to that in a moment, I promise. So that's why we might guide you towards an accountant or some type of seasoned professional who can guide you towards maybe some deductions that you're overlooking, or they might suggest that you contribute to a retirement account, something like an IRA. Because if you can contribute a couple of $1,000s to an IRA and lower your AGI, therefore lowering your MAGI to the point where you become eligible for one of those premium tax credits, it can save you thousands of dollars per year, and you're not spending those additional thousands of dollars per year. It's just going into a retirement account to be used later. You can also save money by picking the right health insurance plan. Specifically, you might want to look for one with an HSA. HSAs are health savings accounts, and the financial gurus out there watching probably get all excited about HSAs. There's a lot of buzz about HSAs in the financial world. And basically this is how it works. An HSA, health savings account, is your account that you set money aside in for qualified medical expenses. Now in 2021, an individual can set up to $3,600 aside in an HSA, and a family can set up to $7,200 aside in an HSA. That's a pretty significant chunk of change. So again, if you're somebody that's on the cusp of one of those income brackets, working with a plan that has an HSA and contributing towards your HSA might lower your AGI and possibly therefore your MAGI to the point where you're eligible for a tax credit, again, saving you thousands of dollars per year on those monthly premiums. So HSAs, unlike retirement accounts, you can use the money right now. You don't set it aside for later. Basically, you can use it right now. It's still your money as long as you use it for qualified medical expenses. So you need to go to the doctor, you need to pay for a copay, use the money from your HSA. You have a surgery coming up or dental work, use the money from your HSA. It can be used right now and there's no penalties for withdrawing it as long as it is for a qualified medical expense. Now there are some additional benefits as well. HSAs are interest-bearing accounts, and that interest that is accrued is tax exempt. And also, if you can hold on to that HSA until you're 65 and continue to contribute it year after year, or even just leave it there and don't touch it, when you turn 65 and you retire, you can convert it to a basic retirement account and use it for whatever you want. So they really are a great option for a lot of people, financially speaking. Now, the only drawback here is that HSAs can only be used in conjunction with high deductible health plans. Now, I gotta pause for a second because I would be remiss if I didn't mention we have a whole video that's dedicated to HSAs and HDHPs. We're just touching upon it briefly in today's video, but if you want a deeper dive, check out that video, which I'm gonna put in the description below. So HDHPs are high deductible health plans. As a reminder, your deductible is the amount that you have to meet out of pocket before your insurance kicks in. So these plans have higher deductibles, so there's more that you have to pay out of pocket before that cost sharing begins. And that's not to say that it's a bad thing. For some people, it's still a really, really good thing. If you are a young, relatively healthy person who uses basic medical services, then maybe a high deductible health plan would be ideal for you anyway. Because under the Affordable Care Act, there are still essential benefits that are covered even before your insurance kicks in, before you meet your deductible. And there are certain services that are covered at no cost, regardless of whether you've met your deductible. There's a full list available of those on Healthcare.gov, and yes, I'm gonna put that in the description below. However, high deductible health plans are not for everyone. Now, if you are somebody with underlying medical conditions and you need to see a specialist quite frequently, or you have very frequent specific doctor's appointments or diagnostic tests or whatever that maybe isn't covered under those essential services, then maybe a high deductible health plan isn't for you because you're gonna have to shell out a lot out of pocket before you've met your deductible. Also, if you are a family with small young children, there's a lot of doctor's appointments with little kids, so maybe a high deductible health plan isn't for you. This is why we really encourage you to work with a broker. A broker is a third-party liaison who works for you, not the insurance company, the carrier. So if you can explain to a broker exactly what your needs are, what your budget is, they can more or less guide you towards the right plan for you because it is not a one-size-fits-all deal. So that's why we always recommend that you work with an expert. Okay, I promise we're switching gears. We're getting back to MAGI. The reason we spend so much time on AGI is because, well, that's really sort of the thing that you can control a little bit. You have a little bit more wiggle room there. And in all honesty, for most people, as far as Healthcare.gov is concerned, your MAGI is going to be pretty darn similar, if not identical, to your AGI. But Healthcare.gov does ask for your MAGI, so let's take a look at Healthcare.gov and see exactly what you need to know. Okay, so we are back at Healthcare.gov. Now, don't worry, I'm going to put links to all the exact pages that we've been exploring in today's video in the description below, so you don't have to go searching all over Healthcare.gov. But you may want to search on Healthcare.gov anyway, because it really is a wealth of information. So anyway, here we are. We're looking at our MAGI. Now let's scroll down. So it's going to say whose income to include in your estimate. For most people, a household consists of the tax filer, their spouse if they have one, and their tax dependents, including those who don't need coverage. The marketplace counts estimated income of all household members. So you have to include the income of all of your household members. That's very important. Now, basically the way MAGI works, as opposed to AGI, is your AGI is going to be your gross income minus those deductions. Your MAGI may add some things back into your income. Honestly, for most people, your AGI and your MAGI are going to be pretty much the same, but there can be some slight differences, so it is important to know. So your MAGI is the total of the following for each member of your household who's required to file a tax return. So you have your gross income, which is that AGI that we've been talking about just a little bit in this video, excluded foreign income that might not have been included as part of your AGI, non-taxable Social Security benefits, including Tier 1 railroad retirement benefits, tax-exempt interest. However, your MAGI does not include supplemental security income. Okay, so this is a handy chart, which is going to break it down. Now, honestly, a lot of these things are pretty much already part of your AGI, but it's just detailing it specifically. So obviously, your taxable wages are included, any tips if you are in the type of position where you make tips, self-employment income, unemployment compensation, so if you have to go on unemployment for any reason, Social Security disability income, and this is an asterisk here, but do not include supplemental security income, retirement or pension income, so this includes most IRA and 401k withdrawals. There's more notes here if you want to learn more about that. For alimony, it depends. So this is interesting. Divorces and separations finalized before January 1st, 2019, you're going to include as income. Divorces and separations finalized on or after January 1st, 2019, don't include as income. Child support is not included. Capital gains, as we talked about earlier, that's included. Investment income, rental and royalty income. So like I said, there's a lot of overlap here with your AGI. So now before that excluded untaxed foreign income, that's going to count as part of your MAGI if you have excluded untaxed foreign income. This is why I said it doesn't necessarily apply to a lot of people. If you received a COVID relief check, so economic impact and stimulus payments, that doesn't count. Gifts don't count. Supplemental security income, as we mentioned, does not count. Veterans' disability payments doesn't count, workers' compensation, and proceeds from loans. So you don't have to include any of those things. Here's some more frequently asked questions that you can click on if any of these pertain to you. Now I want to scroll back up here. Okay. See how to make an estimate of your MAGI based on your adjusted gross income. This is going to break it down in the simplest of terms, really. So you're going to start with your household's adjusted gross income, which is what we've been talking about. You can find that on your taxes. Then you're going to add in the following kinds of income, if you have any. So that's that tax-exempt foreign income, tax-exempt Social Security benefits, and tax-exempt interest. Step 3, adjust your estimate for any changes you expect. Consider things like these for all members of your household. If you expect a raise, if there's new jobs or employment changes, changes to income from other sources, or changes in your household. And that's it. Now you have an estimate of your expected income, and that's basically your MAGI. Let me mention before I forget, should your information change at any time, it's really, really important that you update your info on Healthcare.gov. Now you can call them, you can do it in the portal, but you cannot send in any type of mail letting them know that your information has changed. So this would be if your household size or your income or even your address has changed. It's really, really important that you update your information, because things like this can have an effect on your eligibility for those premium tax credits that we might have mentioned once or twice in this video. So you really, really want to stay on top of it, because if your eligibility changes, then you may end up either A, leaving money on the table if all of a sudden you become eligible for a premium tax credit, or B, all of a sudden you've become ineligible and now you have to pay it back come tax time. Again, not a welcome surprise. Now, if you have any questions whatsoever, please feel free to give us a call here at iHealthBrokers at 888-410-0344. I said it earlier, I'll say it again, there's no charge for our services and we really are here to help. And we're licensed nationwide, so no matter where you are, what your question is, we can absolutely assist you. And if you liked this video, please make sure to click like and subscribe as well to stay up to date on all things health insurance. Thank you so much, have a great day, bye-bye.